Section 6 is going to cover measuring domestic output and national income. So this is all basically going to figure out how do we assess the health of our economy. The first term we look at is national income accounting. So it's just looking at the overall performance of the economy. And we have the Bureau of Economic Analysis, or the BEA, gathering data on income and product accounts on our economy. Gross domestic product. Another way to say this is just GDP. It's our aggregate output. So how much goods and services our economy is producing per year. Annual just means per year. So we take the total market value of all final goods and services that are created within that year. And that is our GDP, our gross domestic product. So our GDP includes all goods and services made that are either citizen supplied or foreign supplied resources employed within the country. So goods and services produced on U.S. soil. We use GDP as a monetary measurement so we can compare relative values over different years of producing different amounts of goods and services. One of the things we have to make sure we do not do is multiple counting. So to avoid multiple counting, we ignore intermediate goods. Intermediate goods would be goods and services that are purchased for resale to be further used down the production process. Final goods are those goods and services that are actually at the end. So it's sitting there on the shelf ready to be purchased by the consumer. Another thing that we look at is the value added. So this value added tells us how much each good and service is worth on our step and on our process to the final good. So when we just look at the value added, it avoids the multiple counting, because to get the total value of that final good, we just add up each value added of each step, or at each stage. So here we have a stage of production, say for a suit. First, it starts off on the sheep ranch. So it goes from 0 up to the sheep ranch. Say it costs $120 for the sheep ranch. So that value added of this ranch would be 120 minus the previous sales value, which was 0. So we know that this sheep ranch added $120 worth of value to the suit. Next, we have the wool processor. The wool processor had a sales value of $180. So we get the value added by just looking at 180 minus the previous here, 120. So that gives us our value added of 60. Then we just keep going down the line for the suit manufacturer, the clothing wholesaler, and then finally to the retail clother. When we sum up all of this, all the value added, 120 plus 60 plus 40 plus 50 and plus 80, that's how we get 350. So the total amount that this suit would add to our GDP, given that it was produced within the country, on our soil, would be $350. GDP does not include non-production transactions, so things such as purely financial transactions and also second-hand sales. So if you buy anything used, when you purchase that used good, it is not included again in GDP. Some examples of financial transactions are public transfer payments, so payments the governments make directly to households, and this does not contribute to current production. The next is private transfer payments, and this is when funds are transferred from one private individual to another. The idea is that you get a Christmas card from your grandmother and it has $10 in it. That would be a private transfer. Our third type of financial transaction is a stock market transaction. So when you purchase stock, you're not creating anything in the way of a new production. That production does not happen until the business decides to take that additional cash on hand and make something with it. But when you just purchase stock, that does not add to GDP. And secondhand sales do not contribute to current production because the good has already been produced. When you buy a used car, that car isn't being reproduced again. It's already there. You're just buying it from somebody else. So that's why we exclude secondhand sales from our GDP. We have two ways to look at GDP, through spending and through income. The expenditures approach, the output approach that we're mostly going to be looking at in this section, views GDP as the sum of all money spent and buying it being the goods and services. And then the income approach is looking at the earnings or allocation side to it. So GDP is in the terms of income derived or created from the process of producing that final service or final good. Alright, in our expenditures approach, all we do is add up all the spending on final goods and services that take throughout that year, because remember, GDP is an annual number. So first we have personal consumption expenditures. This is going to be our C. Personal consumption expenditures is all the money that we as individuals or households spend on durable, non-durable consumer goods, and then also on services. You guys should remember that durable goods are 3+ years that they can be used. So they last 3 or more years. An idea like this would be a car or a house. Non-durable goods would be something like food, things that last less than 3 years. So remember, personal consumption is all of the money that individuals within the society spend on final goods and services. Next, we have gross private domestic investment. This will just be represented by an I with a little g. So when we talk about investment, we think about it in terms of economic investment. So the purchases of machinery, equipment, and tools. Remember, it's this idea of capital by business enterprises. All construction, so expanding your business, and then also changes in inventories. We can have positive and negative changes in our inventories. It all depends on either how much that company is selling compared to how much they're producing. So if an economy produced more output than was purchased, including the increase in inventories as investment will correctly measure the output produced that year. So if the economy produced more output than was purchased, then we're going to measure the output produced, that additional output. But if inventories decrease by selling goods produced in prior years, so those goods would have already been counted as GDP in the year that output was greater than the amount purchased. Right? This is when inventories are increasing. And then down here, our inventories are decreasing. So we consider these declines in inventories as negative investment. So we subtract it from the total investment. So if you have positive inventories or positive change in inventories, then you add it to gross private domestic investment. And then if there is a negative change in inventories, you subtract it from domestic investment. We also have non-investment transactions. So remember that investment has to do with creation of new capital assets. So we want assets that create jobs and income. So if people just merely transfer the claims to existing capital goods, that's not a creation. That's just more of a secondhand sale. We also have a difference between gross and net investment. So when we talk about gross investment, then we're talking about all final purchases of machinery, equipment, tools, all construction, and then changes in inventories. When we talk about gross, it means all investment goods. So both those that are replacing machinery, equipment, and buildings, and any new additions to the economy's stock of capital. Net investment includes only investment in the form of added capital. So it's only looking at the new. Whereas gross looks at the replaced machinery, equipment, and buildings and the new additions. So to get net investment, we just take gross investment minus the replacing, the depreciation. So it's the amount, depreciation is the amount of capital used up over the course of a year. So how much of your capital good is being used up over that year. Just like dis-saving, we can also have disinvesting. So that means we're using up more capital than it's producing. So that when disinvesting occurs, the nation's stock of capital will shrink. It'll become smaller. Next we have G, which is our government purchases. So our government purchases have two components. First, we have expenditures for goods and services that the government consumes. And they do so by providing public services. Right, this would be the idea with police, the military, our water systems. And we have expenditures for social capital, so schools and highways. They have long lifetimes. And it's very important to note that it does not include government transfer payments. Lastly, we have net exports. So use net exports with an X lowercase n. It's the idea that international trade transactions are a significant item, so we have to include it. Our net exports would be X being our exports minus M our imports. So our exports are all the goods and services that we're selling overseas. M is equal to all of the goods and services that we, the United States citizens, are buying from foreign countries. So our net exports is just equal to the amount that we're sending from our country to the amount that we're putting into our country. Once we add all of these variables together, GDP is equal to personal consumption expenditures plus gross investment plus government spending plus net exports. It's very important that all of you remember this equation. So this is our expenditures approach. Next, we have the income approach. So we start off here with the compensation of employees. So we have our wages and our salaries that are paid by business and government to their employees. These same wage and salary supplements are payments by employers, so they also pay them into social insurance, private pension, health care, and also welfare funds for workers outside of the straight check that you get in the mail or in your direct deposit. We also have rents. Rents would be income from supplying property resources. Compensation of employees would be income from labor resources. Interest is from people that supply capital, money capital that is. Whenever you have to pay interest on a loan because you've borrowed something, you've borrowed money. So if you're on the other end of that and then you lend someone some money, then you gain interest on that money that you lent out. We also have proprietor's income. So in proprietor's income, profits are broken down into two different types of accounts. First, proprietors, which is the net income of sole proprietorships, partnerships, and other unincorporated businesses, and then corporate profits. Do you guys remember the difference between our sole proprietorship, partnership, and corporate or corporations? The biggest difference is that corporations have limited liability. Remember, it's the idea if someone comes and sues this corporation, they can only go after the corporation's asset. Whereas if someone sues a sole proprietorship or a partnership, they can go after their homes and their children's college funding or whatever else they have saved up aside. So the earnings for corporations are put into three categories. First are corporate income taxes. Those are levied on corporations' net earnings and then flows to the government. Next is dividends. That's when corporations pay part of their profit to corporate stockholders, so it flows to households. And then the third is undistributed corporate profits. For those of you that have taken accounting, this is your RE, your retained earnings. So it's when the corporation saves the money, and then they're going to invest it later in new plants and equipment. We also have taxes on production and imports. So sales taxes, which is on general goods, say if you're going out to eat, you pay a sales tax. It doesn't matter which type of restaurant you go to or what type of food you eat. Excise taxes, which are specific goods, like the tax on alcohol, taxes on cigarettes. We have business property taxes, license fees, and also customs duties. National income to GDP. National income is just all the income that flows to American supplied resources, whether here or abroad. And then we also include taxes on production and imports. Our net foreign factor income is going to be the difference in the incomes Americans gain from supplying resources abroad and the income that foreigners gain from sending resources into the United States. This net foreign factor income is the income equivalent of net exports. So what we do is we subtract net foreign income from the U.S. national income to stay on the correct path to use this approach in order to get the U.S. domestic output. And then it also needs a statistical discrepancy. So in order to match the outcome of the expenditures approach, the income approach needs this discrepancy, which is why or another reason why we spend most of our time just looking at the expenditures approach. The income approach also looks at depreciation, so it estimates how much of the capital that's used up each year. Some other national accounts we have here would be net domestic product. That's when we adjust GDP for depreciation. National income is when we subtract this statistical discrepancy from our net domestic product and add net foreign factor income. So it would just be NDP minus that statistical discrepancy plus our net foreign factor income. Our personal income is just all income earned for us as individuals. Disposable income I've already touched on in an earlier section, where it's just our consumption plus savings. Remember, savings is just not consuming. So another way to find this disposable income is that it's equal to personal income minus taxes. So now we revisit this circular flow. Here we have net export expenditures. So this is our XN. We have investment expenditures going from businesses. Right, this would be our IG right here. The U.S. government has government purchases. This is our G. And then down here we have our C. So here we see IG, government spending, consumption, personal consumption expenditures, and net exports. All of this together gives us our GDP. So everywhere in the orange, and what I just circled here in the red, or wrote down in the red, is our expenditures approach. Now over here we have our personal income less the personal taxes that go to the U.S. government, right? Turns into our disposable income. Over here we have our national income and our net domestic product. All of this green here, this is all the income approach. So now we have our nominal versus real GDP. Nominal is when we have GDP based on prices that prevailed when the output was produced. So that year. Nominal is unadjusted. Real is when we adjust for inflation or changes in the price level. So if it's inflated, if the general level of prices increase, then we'd have inflation. If the general level of prices decreased, then we'd have to deflate it. We have deflation. So we can have two ways to adjust this nominal GDP to reflect our price changes. First is our GDP price index, and then second is to gather separate data on physical outputs and then determine the market value of outputs if the base year price had prevailed. So method 1, we find nominal GDP for each year, compute the price index, and then we divide each year's nominal, so we divide all of these nominal GDPs by that year's price index to determine the real GDP. And this is the method that we're going to be learning. So first we have to find this price index. So this price index is when we measure the price of a specified collection of goods that we're just going to call this market basket. So think of it as you're going out to have lunch in the park, right? You have a little picnic basket with you. Well, in this picnic basket, we have these specific goods. And within that basket, those goods are what we're going to use as a measurement to create this price index. So to get our price index in the given year, we have the price of the market basket in the specific year over that same market basket in the base year. So we look at these two prices. Same basket. On top we have the specific year. On the bottom we have the base year. And then we multiply it by 100. To get real GDP, we just take our nominal GDP and then divide it by our price index. So here's how we can do it. First, to find our nominal GDP, we just take our units of output times our price per unit. So here, 5 times 10 equals 50. 7 times 20 equals 140. 8 times 25 equals 200. 10 times 30 be 300. And 11 times 28 will be 308. Now for our price index, we have the price of the market basket in specific year, which is 10. Price of the same market basket in the base year. In this example, year 1 is our base year. So 10 divided by 10 is equal to 1. Multiply that by 100 and we just get 100. So we go on to the second one. Market basket in specific year is 20. 20 divided by 10 times 100 is equal to 200. Same thing for 25 divided by 10 equals 2.5 times 100 equals 250. So down here, 30 divided by 10 equals 3 times 100 equals 300. And then 28 divided by 10 would be 2.8. And then times 100 would give us the 280. So now to get this adjusted or real GDP, we take our equation here. So this is going to be equal to our nominal GDP, 50, divided by the price index. Notice that it says in hundreds. So another way to write this is nominal GDP over our price index, and that's over 100. So go ahead and divide that price index by 100 before you divide this number into nominal GDP. So 50 over 1 is just equal to 50. To get the second, our nominal is 140. That's divided by price index. Right, 200 over 100 would just be 2. So that's equal to 70. And then we have nominal of 200. Divide that by our price index, 250, divided by 100. That gives us 80. Then next we have nominal of 300. Divide that by 300 over 100, which would just be 3. That gives us a real GDP of 100. And then lastly, we take our nominal 308 divided by our price index divided by 100. So it'd be 308 divided by 2.8. So that gives us 110. All you guys need to do is just remember these equations here. So remember how you get the price index, remember how you get real GDP. Another way to do it is just to flip the equation around, and if you can find the price index here, just equal to nominal divided by real GDP. All we're doing is just playing a little algebra with this equation here. Some real world considerations and examples. So we consider this chain type or annual weights price index. We look at this price index as CPI. So here, if we want to find this price index, we have our real GDP, our nominal GDP. Remember, all that we do, we take our nominal divided by the real to get our price index. So it would just be 2789.5 divided by 5161.7. And that gives us another number. I'll be so happy once I'm done with all this, dude. Times 100. So that gives us 54.0. And then here we can just come here and test it. We'll try it again. Take our nominal, 4220.3 divided by 6053.7 times 100, and that gives us 69.7. So to find our real, all we do is take our nominal, 5803.1, divide it by our price index, 1.6, which is divided by 100. And then that gives us 7,111.6. And then just do the same thing down here for our next real. We do have some shortcomings of GDP, and that's it does not capture non-market activities, so things that go on in the black market or things that are not legal but they're still sold and produced in the US. That's not going to be included because GDP measures only the market value of output, so things that we can measure. Or we can't measure drugs that are trafficked across country because they're illegal and we don't know we don't know the exact price that each individual is paying for it. Whereas we do know the price that individuals are paying for coffee or for tomatoes at the supermarket. We also have a problem because it cannot measure leisure. So we ignore leisure's value when looking at GDP. For a lot of people, they choose not to produce more just for the fact that they have a shorter work week. They value leisure more than the additional income. It also has a problem with improved product quality because it only looks at the prices of the final goods. So if you were to look at the prices of computers 20 years ago and compare them to the prices of computers now, you notice that the prices on average are significantly lower. Yet the power and the quality for computers is just completely magnified compared to 20 years ago. It's so much better. This underground economy, I touched on it with the non-market activities. So we can't really measure it, right? Because we don't know how much of it's going on. We don't have the data for it. Also, if we have social costs, negative byproducts like, say, CO2 for driving, or sludge that's pumped into a local lake from a factory or something like that, if it's producing more goods and services, then that will be captured in GDP, but the detriment to its surrounding environment is not captured through GDP. Also, the distribution of output can make a difference for society's overall well-being, meaning on who gets that distribution of output and who gets to consume those final goods and services. The GDP also does not measure the total well-being. There are many things that can make society better off, such as increased leisure or better environmental awareness and protection. But that's for society to decide and can be affected and can be increased without necessarily raising GDP, so GDP would not capture that. All right, that's section 6.